What is an income statement? Love this topic. Not quite as much as what is a balance sheet, but it comes in as a second close. Number 2. What is an income statement? Well, this is the statement that most entrepreneurs are familiar with. This is certainly the one that gets the most love, if you will, from an entrepreneur, a business owner, and their finance team, or their accounting team, rather. So the income statement, really simple. What's our revenue? What are the costs associated with earning that revenue, which means we have gross margin left over. After we've spent our gross margin on our costs for running the business, then what's left over at the end should be our net profit or our net margin. So an income statement tells you what your business earns, what its costs are, and what's left over after it pays for its costs. Now, here's where it gets a little tricky for entrepreneurs and business owners who are looking at their profit and loss statement. A lot of entrepreneurs just do thumbnail math. They'll say, look, we sell a bunch of products and we make $1 million. It costs us, $800,000, so we should have $200,000 left over. That's typically how entrepreneurs and business owners talk about their business. Instead, what they should be saying is correctly. I mean, if you have a copy of your income statement in front of you or your profit and loss statement, take a look at it because it might help to see it as we talk about it. So what an entrepreneur should be able to say is, okay, we generate $1 million worth of revenue, but our costs to generate that revenue are $700,000, which means we have $300,000 left over to pay for our what's called general and administrative costs. So after we pay the salaries in the office and the toner cartridges and the paper and the paper clips, costs us $200,000. We have $100,000 left of net income. So an entrepreneur should know its gross margin, its net margin, or its gross revenue and its net revenue. And the reason why that's important is because those two things tell you something very, very different. Your gross margin or your gross profit tells you with all the sales that you make, how much money is left over to pay for the costs of the business. And your net margin or your net revenue tells you, well, how much profit do we make after we've paid for the costs of our business? And as you look at those numbers, your profit and loss statement should break it out like that. So for example, if you sell bicycles, you have a bunch of costs associated with putting that bicycle together. You have the materials that you have to pay for in order to have a bike. You have the labor involved in assembling the bike, and then you typically have shipping costs. So after those costs are deducted from what you sold the bike for, then there's an amount of money left over to pay for costs that are not directly related to the bike, like the rent for the shop or the phone system or your internet bill for all of the people that are using computers and sending emails to customers. So your costs are your direct costs and then your indirect costs, gross margin, net margin. So as you look at your profit and loss statement, it's really important to understand the difference. Now, if you're looking at it, you might be saying, well, what's like a good rule of thumb? Well, unfortunately, there is no good rule of thumb. If you were to look at Walmart's profit and loss statement, what you would see is that their gross margins and their net margins are really, really small. Like we're talking 1 to 2 to 3%. And the reason why they're so small is because they do such massive volumes. And because they do so much volume, they can afford to have lower margins because that's how they make it up. They make it up on scale. But for most businesses, for most small, medium-sized businesses, you want to target on say $1 million worth of sales, you want your gross margin to be at least $300,000 to $400,000. And at $300,000 to $400,000 or 30 to 40%, you should be able to keep 10 to 15, maybe 20% on the bottom line. Now that's really, really rough math. So if your business isn't doing that, don't send me hate mail. Or get upset because there might be some other extenuating circumstances. But as a general rule of thumb, the entrepreneur looking at their income statement should be able to say, that's how much revenue we earn. This is what it costs us to earn that revenue. And as a result, here's what's left to pay for the costs of the business, which produces profit. And if you don't have profit on the bottom line, then you got to work your way from the bottom up and say, okay, are the indirect costs associated with our business simply too high? Can we lower those costs somehow? If you say no to that, then you keep moving up and you say, okay, well then how do we improve our gross margin? Can we reduce the costs associated with producing the product or the service that we have? Can we pay lower commissions? Can we pay less for the bike rims? Can we pay less for the bike frame? Can we find a different supplier for some of these things to lower our cost? And if the answer to that is no, then the only thing you're left with at the very top of the page is your revenue. And you have to ask yourself, do we charge more then? Do we charge more for our product or a service? We have a higher price point. Our costs to produce the product or service remain the same, and then our overhead or our indirect costs remain the same, which means our profit would go up. So your balance sheet is important because it tells you what does the business own, what does the business owe, and what's left over. Your income statement tells you what does the business earn, what does the business spend, and what's left over. So if you're an entrepreneur or a business owner and you're struggling to figure out how to read your financial statements, don't let your eyes glaze over because it appears to be complicated. Or maybe you say, look, numbers are not my thing. Okay, that's fine, but you still need to understand how your business generates profit. You sell a product or a service, you incur costs associated with that product or service, that sale, and then you have the indirect costs of the business that you have to pay whether you do sales or not. So you should be able to understand your business in those kind of sections. Here's how we generate revenue. Here are the costs associated with that revenue. Here are the costs associated with running our business. And then here was what should be left over at the end of the day. So hopefully you find that somewhat instructive. Not tricky stuff. It can be tricky if you let guys like me keep talking, or finance people kind of get at your desk because they'll try to lead you all over the place. But keep it really simple. What does our business earn? What does it spend to get those earnings? What do we spend irrespective of our earnings, our office costs, etc.? And then what's left over? How do we actually make profit? And then from there, you can follow your profit into the retained earnings or shareholder equity line on your balance sheet. You can watch the other episode that talks about what is a balance sheet to understand that. But hopefully now you've got a better point of reference for understanding what an income statement is, also known as a profit and loss statement.